Yeah, it's alt season in the equity in the traditional capital markets for sure. Stablecoins and tokenization are going up and to the right from interest levels. Now you have Visa, MasterCard, PayPal, Goldman Sachs, everyone realizing that they need to be ready for this era, that we could be dealing with, multiple trillions of dollars of stablecoins and multiple trillions of dollars of tokenized real world assets in the next year or two.
Matt Hougan begins with a bold but well-supported thesis. The era of extreme 70% crypto drawdowns may be fading into history. Why? The market structure has fundamentally changed. This isn't 2014, 2018, or even 2020 to anymore. A lot has evolved. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. Take Bitcoin halvings, for example. These used to be the primary catalyst for parabolic price moves, but Hougan explains that the impact is mathematically diminishing. Yes, each halving still cuts new supply by 50%, but in absolute terms, the reduction shrinks every cycle, making it less of a singular driver for future price surges. Now, let's go back to the video.
I do think the market is going to be more stable in the past. I think some of the factors that drove that boom and bust are now diminished. So an example of those, I think the impact of the halving is smaller, just mathematically. It's half as big each time. I think if you look at the interest rate cycle, we're at a different point in the interest rate cycle than we were in the 2022 and 2018 bear markets when interest rates were going up. Now they're as liable to go down as up, right? So that's a different situation. And I do think that the advent of regulation will reduce the blow up risk that has been the catalyst of so many sharp pullbacks, right? If you go way back in time, what caused the blow up in 2014? It was Mt. Gox collapsing. What caused the blow up in 2018? It was ICOs being shut down. What contributed to the blow up in 2022? It was a cavalcade of disasters, Luna, FTX, 3 Arrows Capital, etc. Now that we have, and as we get better regulation, you would expect that to be reduced. And then at the same time, you do have institutions turning towards crypto. And unlike retail, they're battleships. They're not speedboats, right? They take years to turn. One of my favorite statistics and most painful statistics is the average Bitwise customer allocates after about 8 to 10 meetings. If you think about what that means for a pension fund that started looking at Bitcoin when the ETF launched, they haven't gotten through 8 quarterly meetings yet. That's the speed. They'll get there in 2026. So I do think for that reason, the cyclicality will be compressed. There'll still be volatility, but I don't think we'll see 70% drawdowns. Yeah, it's alt season in the equity in the traditional capital markets for sure. Bitcoin Treasury, ETH Treasury companies, IPOs. I think that's part of it, Andrew. And part of it is like, look, a lot of people moved into the market when Bitcoin ETFs launched in January. The traditional alt cycle was like people would buy Bitcoin, it would go up, they would get wealthy, and then the capital would flow downhill into riskier assets. People bought Bitcoin ETFs, they got wealthy, and the capital is flowing downhill into riskier assets, but within the TradFi ecosystem, because that's where that capital is, right? And that's part of what explains why we're getting ETH treasury companies and now Sol treasury companies and everything else. It's the same altcoin cycle. Is if you think about why Bitcoin has done so well over the last 18 months, it's been a really simple story where ETFs and corporations have bought something like 5x the new supply.
Yeah.
There's been more demand than supply. Well, actually, since the start of May, ETFs and corporations have bought 32x the supply of Ethereum because we've had this huge growth in Ethereum ETP flows, right? They did, I think, $5 billion over the last 8 weeks. And we've had this huge growth of corporations buying Ethereum. So the same sort of supply demand story that drove Bitcoin for the last 18 months, and Ethereum just kind of sat there and went down, is now happening in Ethereum. So there's a vibe dynamic and there's a supply demand dynamic. And you have to ask yourself, will these vibes continue? Absolutely. Stablecoins and tokenization are going up and to the right from interest levels. And then will the supply demand dynamics continue? I think absolutely. Ethereum inflows don't look to me like they're going to reverse. And these ETH treasury companies are trading at something like 2x their NAV, which means there's going to be more of them. So at least from the short term, I think the trends we've seen since the start of April really are going to persist in ETH, and I'm pretty bullish, and I think it'll get to new all-time highs. I am more tempered than that. I think we get above new all-time highs. I think it may well outperform Bitcoin through the end of the year, and I'm very bullish on Bitcoin's price. But I don't know that we, what is that, a 4.5x from here? I'm not sure that that's in the cards, but I do think the trends are all in its favor. Supply demand dynamics, stablecoin and tokenization interest. I think it's a very bullish outlook for Ethereum. Maybe not Tom Lee bullish, but very bullish. This is like the moment when Walmart realized it needed to build a website to compete with Amazon, right? Yeah. Now you have Visa, MasterCard, PayPal, Goldman Sachs, everyone realizing that they need to be ready for this era, that we could be dealing with, multiple trillions of dollars of stable coins and multiple trillions of dollars of tokenized real world assets in the next year or two, right? I mean, it's moving at that speed. So I do think that is a major fundamental shift. I do think it's akin to the internet going mainstream. And I don't think we'll ever put the genie back in the bottle. I think now that we're through, it's now part of our mainstream financial infrastructure in a really fundamental way. Stablecoins are sort of a skeuomorphic tool for crypto. There's something that matches our existing understanding of how finance works, but just makes it faster, quicker, better. I find that traditional investors can understand stablecoins faster than they could understand Bitcoin, and certainly faster than they understood something theoretical like blockchain, that you're trying to describe how this technology worked. It's like, no, here are dollars that move at the speed of light and settle instantaneously around the world. And people say, oh, that's cool. So I do think it's really helped with the vibe shift. I think it's made crypto real. Yeah. And it's also brought in Wall Street, which is important because it solidifies the regulatory environment for crypto, right? It's no longer crypto versus Wall Street, it's crypto and Wall Street. And that means that Washington is now pro-crypto on a long-term basis. And that's been the other major vibe shift that I think it's brought on.
Don't just look at peak earnings during bull runs or crash era lows. Instead, think in terms of blended or cyclical earnings, similar to Robert Shiller's CAPE ratio, which averages 10 years of data to value the S&P 500 more realistically. Hougan argues that crypto firms should be analyzed the same way, smooth over time, across multiple market cycles. Why? Because these RWAs tech fads are becoming foundational pieces of tomorrow's financial infrastructure. Now here's a kicker. Even that cautious framework might still underestimate Ethereum. If Ethereum truly becomes a backbone of global finance powering stablecoins, tokenized assets, smart contracts, and decentralized ID, then a $400 billion market cap doesn't make sense. Hougan says it's straight. $4 trillion or more is not a fantasy. It's the logical conclusion of network effect meets global infrastructure.
On this one, we really saw two things at work. So on the one hand, we were optimistic on the outlook for crypto. And if you're optimistic on the outlook for crypto, you think the market for companies building in this space is growing and substantial and there to be. The other factor that went into that prediction is that the IPO market was severely repressed by US regulators for the 4 years prior to this election, right? Circle, as an example, which for what it's worth has been the most successful IPO in the US in, I think, 10 years, right? It was 25x oversubscribed. The price has gone up 8-fold. It's been huge. Mm-hmm. It tried to go public for 3 or 4 years, but the SEC wouldn't let it out. And so we saw all of these firms that were substantial in size, whether it's eToro or Circle or Kraken or Chainalysis or some of the others that are in the pipeline, that were sort of just waiting at the door. So once that regulatory environment changed, we thought they would run out. Now, I do think it's primed for this moment we're in, because there are a lot of professional investors, institutional investors, financial advisors who want exposure to crypto, but are more comfortable with these companies. And I think that these IPOs and crypto equity ETPs are feeding into that group that want exposure because they know crypto is happening, but maybe their risk departments aren't comfortable with owning Bitcoin, but you can have exposure to Circle, you can have exposure to Coinbase, you can have exposure to some of these pre-IPO companies. So we think this trend is going to accelerate. When we think about Coinbase's or Ethereum's long-term valuation, I think you need to treat it akin to how you treat a cyclical stock, which is effectively to blend the earnings across a full cycle, right? Particularly because crypto has been so cyclical. I think it'll be less cyclical going forward, but you can't just look at peak earnings because, as you said, valuations would look cheapest at that point. If you look at Coinbase historically, if you blend earnings or maybe do an exponential weighting of blended earnings over the last 4 years, I think you get something closer to its true valuation. I don't know if you're familiar with the CAPE statistics that Professor Schiller used to put out about the stock market, but he would look at price to earnings across like a 10-year period. I think in crypto you have to do something similar to that, or you can take the approach that's equally appealing to me, which is we're still in the very early phases of this, right? And so what matters is market share. To Alex's point, a lot of activity is taking place on layer 2s on ETH. It's very dispersed. But from my view, the ETH bet is that a huge chunk of the world's money and assets will move over ETH. That's the bet you're making. And if that's right, it's not a $400 billion asset.
Yeah.
Right. It's a $4 trillion asset or something above that. And that's like enough valuation work. Really, I can do the DCA stuff. I can do, but in the end, that's the bet I'm making when I buy ETH, is that this will be the rails for most of the world's money and assets, the same way the internet is the rails for the world's communication. And boy, will that be valuable. So I sort of think you can take either approach when you think about it. And people ask the same questions when the gold ETFs launched in 2004. Will this cannibalize other ways that people purchase gold? Will they stop buying gold bars and coins? And what we saw was gold ETF assets went up substantially. They eventually got above $100 billion. And the number of people buying gold coins and bars also grew 3 or 4x. And the reason was that the ETFs helped make gold a mainstream institutional asset. So it dramatically broadened the market, and people found all these different ways to add in. So I think what Bitcoin ETFs have done is they've helped push Bitcoin into the mainstream of institutional adoption, dramatically widen the pie. And yes, of course, some people will find these other ways to gain exposure. They want the levered style exposure that MicroStrategy provides. But we're not sad about that at Bitwise. In the same way, I compete with BlackRock, and I wish I had their assets and their Bitcoin ETF. But BlackRock being in the market has grown the market for Bitwise as well. So at this point, it's just about growing the pie, and I think that's what's happening with these Bitcoin and ETH treasury companies.
Some critics fear that the Bitcoin ETF would cannibalize traditional exposure, like cold storage wallets or direct coin purchases, but history tells a different story. Take gold, for example. When the first gold ETF launched in the early 2000s, many thought it would replace physical demand. Instead, the opposite happened. Coin and bar purchases tripled. The ETF didn't cannibalize interest, it amplified it. We're seeing the same playbook unfold with Bitcoin. These ETFs aren't replacing hodlers, they're onboarding a new class of institutional and retail capital that would have never touched private keys. The more ways there are to access Bitcoin through ETFs, treasury strategies, IPOs, the bigger the total pie becomes. Thanks for watching. If you found this valuable, the next video is even better. Click it now and let's keep going.